CPI came out earlier today, and there's a lot of talk about will this mean that the Fed can stop raising rates? CPI came in at expectation for the first time since about 2021 May. We are below 5% for the CPI, and everybody's getting very excited about what this could mean for the next Fed meeting. Will we finally be in a pause? Could there be a potential cut? Doubt it. Will there be a raise? We'll see. Today, we're going to talk about it and why I think everybody needs to remain cautious but optimistic. Welcome back, everybody. If you're new, my name's Nicholas, and this is Investing Against the Grain. We're not only going to talk about CPI, but we're also going to talk about the broader economy and what really needs to change and why this may not be the time to really get aggressive and take, your emergency fund, your savings, whatever you have, and throw in the stock market. There still may be, time for that in the future. And I just want to go through this and kind of talk about it. And I want to show you a very, very important video. Stick to the end. This won't be a long video, but it's a very important clip I want to show you from a YouTuber who was just at a conference with a important Biden, trusted advisor who gives him advice about the economy. And it's very telling about when things might really change and what to keep at look out for the horizon. All right. So first, let's dive into the CPI report. So here we can see this is CNBC. We see the headlines read here: inflation rate eases to 4.9% in April, less than expectations. That's great, right? That's what we want to see. But the devil's in the details, right? So let's actually take a look at the report. I've already gone through this so that we can pick out some of the important things. So index increased 4.9%. We've already talked about that, right? That's what we just saw here. So here we can see indexes which increased in April include shelter, used cars and trucks, motor vehicle insurance, recreation, household furnishings, and operations and personal care. The index for airline fares and the index for new vehicles were among those that decreased over the month. So this should resonate with everybody, especially if you're investing in Tesla, especially if you see what's going on with Ford and GM, Stellantis, BYD, et cetera. We see that the cost for new vehicles are coming down. Shelter is clearly still a problem. Used cars are still very high. They're going up, right? It's the seesaw effect. So this kind of gives you a broad view about, a little more about the details. We're going to dive deeper though. Okay, here we go. The all items index increased 4.9% for the 12 months ending April. This was the smallest 12-month increase since the period ending in April 2021, right? So that's definitely bullish, right? We're heading in the right direction. The all item less food and energy index rose 5.5% over the last 12 months. So what that tells you is a lot of this deflation that we're seeing is coming from energy prices decreasing. The energy index decreased 5.1% for the 12-month ending in April, and the food index increased 7.7% over the last year. So the two things that we're going to really notice here is that food is still very expensive and that shelter is still being a problem for us, right? Remember, shelter is the biggest part of the CPI when it comes to weighting. All right, I'm going to scroll down here. I'm going to try to make sure you guys can see all this. Let me zoom out here. So I just want to point out a couple things, and then we'll get into a little more of the details. So you can see here food, right? Just track this across. Food, 7.7, all right? Now, as far as month over month, right, we see this kind of holding steady from food as a total category. If you look at food at home, this is actually coming down nicely, right? We've gone from 0.6 to 0.5 to 0.4, 0.3, negative 0.3, negative 0.2. So I would say that this is going the right direction. And you know how this works, right? For this 7.1, as we start to lap over these smaller numbers, that number will come down. So this is kind of artificial to an extent, but it's still relevant. All right. Food away from home. This one's interesting, right? We saw the peak back in October, it looks like 0.9, and we're very slowly coming down. We're back at 0.4. We saw 0.4 back in December, but this is a total of 8.6 over the last 12 months. Now, this I think should be expected, right? Restaurants, bars, I don't know, street carts, wherever else you eat away from home, there's always a premium on that. So I take less gripe with that one. I like to see that the food at home is coming down. I think that's a very, very important metric. All right. Energy. Let's look at energy. So this is where I was saying, like, this is where the majority of the deflation is coming. You can see that, like, if I come across here, energy, it's minus 5.1, right, over the last 12 months. If we look at where this breakdown comes from, gasoline, fuel oil, energy service, I mean, you can see all this is the big negative. And so this is where it can be a little concerning that this is where the deflation really seems to be coming from. But again, there are other areas, right? I mean, again, like food, we see that coming down. Let's take a look at what the couple other things. All right, new vehicle prices. All right, so new vehicle, you can look here. Just look across. We actually went negative, and I think a lot of this is pressure from Tesla, to be honest. But that's at 5.4 over the last 12 months. But for the month over month, it was down 0.2%. So I think that's great. However, on the inverse side of things, we see that used car prices, used cars and trucks, actually went up 4.4% month over month. However, again, if we look at it from a more holistic, a longer time frame, we see it's negative 6.6. So again, trending in the right direction. Now, here is the part where with shelter, it's such a lagging indicator that it takes time for this really to come through in the numbers. And frankly, with what we see right now with huge mortgage demands after the Fed more or less signaled they're going to pause or stop, at least stop rate hikes, we saw huge mortgage demand. And so, this can become a very sticky part, I think, of inflation. And this is why I think that even if the Fed does just pause, we will be pausing and be higher for longer as we start to see or to affect these home prices. And we'll touch on this more because I think it's very, very important. And there's something that there's an idea that we have to be very cognizant of before the economy actually covers. Just because Powell pauses does not mean that things are going to recover. It's not good. There are other things, and we'll talk about that in a second. I just want to get through all this first. All right, but anyways, shelter. So here we can see it's still at 8.1%. Transportation services, medical car services, right? Still high, still kind of climbing, right? This is still 0.4, but we see medical services decline. So that's great. Okay, let me zoom back in here. Okay, food at home fell 0.2% over the month, right? That's great. We talked about that. Food away from home index rose 0.4%. Again, we talked about that. So I think, again, expected. The food at home index rose 7.1% over the last 12 months. This, again, should be highlighted that it is coming down. So I do think that's somewhat positive for CPI as a whole. Energy index rose 0.6% in April after decreasing 3.5% in March. The gasoline index increased 3% in April following a 4.6% decrease in the previous month. So this is kind of, regressing back to the mean, but the more important thing is the trend is down to the right. Now, there will be a certain point where oil's not going to go, energy's not going to go down because OPEC will cut outputs. But I think with a potential recession, people driving less, spending less on energy, the move to electric vehicles, I think you're going to really start to see pressure on the oil markets. So while some people may say, okay, all the deflation is coming here in the CPI from energy, this may be something that can stand the test of time as we go through this, this deflationary effect of electric vehicles. Let's scroll down here. The shelter index was the largest factor in the monthly increase in the index for all items less food and energy. Think about that. Among the other indexes that rose in April was the index for used cars and trucks, which increased 4.4%, and the index for motor vehicle insurance, which increased 1.4%. So again, we still have to, keep an eye out for used cars. But I think looking at this from a 1 month perspective is not exactly the right way to look at it. We really want to look at it in a longer time frame, as with all these numbers, really. And it's kind of convoluted because on one hand, I'm telling you, we really want to look at this over a 12-month, even longer term period. But then we also have to understand that with CPI, for example, we are still, adding in numbers from, 11 months ago that were higher than what they are now. So, it can get convoluted. So you just really got to think your way through these numbers. Most important part, the index for all items less food and energy rose 5.5% over the past 12 months, expected. The shelter index increased 8.1% over the last year, accounting for over 60% of the total increase in all items less food and energy. 60%. That's huge. That's a big deal. That's why this matters. That's why I keep talking about this, about mortgages, about home prices declining. Again, stick around. This video I have at the very end. I think this is going to be something that you don't want to miss because it's so important. And I think it's such a good point that's being made here. And if for no other reason, even if you don't disagree, or even if you disagree with it, it's something that you need to have on your mind whenever you are looking at the economy as a whole, when you're making decisions for your family, how you're spending money. Are you buying real estate? Are you not? Are you saving, etc.? Anyways, less food and energy. Other indexes with notable increase over the last year include motor vehicle insurance, plus 15.5%, household furnishing and operations, 5.3%, recreation, 5%, and new vehicles, plus 5.4%, which again, the new vehicles, that is coming down. So I think that's all I highlighted here. Okay, so now what I want to do is I want to go ahead and I'm going to share my screen with you guys, and I'm going to I want to share a video with you that I think is very important. Okay, this is coming from Yashu from Hit That Bid. Let me go ahead and share my screen, so you should be able to see it here. And I'm going to go ahead and play this, and I've already marked it up, so it's going to be about 1.5 minutes long. So stick with me, and I will talk about what he's saying afterwards. And again, this ties back to shelter, housing prices. This ties back to CPI and why the Fed will probably stay higher for longer. So let's listen.
Right. One, I mean, Biden is literally hearing from her, right? That's one big reason. At least we can try to understand the thought process behind it. So Biden and the staff are hearing directly from her on a monthly basis. But then also we try to at least, as we're watching this, retail investors like us try to guess, like, where does the government, like, what is the government saying for narrative, and what do they actually think, and like, what are they being fed? And the biggest underlying narrative that I kept getting from this was that we're not out of the woodwork yet. They're looking towards the end of the year as a recessionary. They called it the long and variable lag, right? This term coined in the 1960s. Interest rate hikes may be behind us. Let's say the majority of them, at least the vast majority, but the effect is still ahead of us. And the housing market is surprisingly strong, right? In Canada as well, especially in Canada, we're seeing housing prices going up here again. But that long and variable lag that they talk about is something that they're acutely watching for towards the end of this year. That big recession that everyone's fearing, that everyone thinks, oh, well, actually, it's probably behind us, is something they're watching for the end of this year. So we're not out of the woodwork yet. And the big reason and the rationale that she was talking about behind the velocity of rate hikes and the continual rate hikes and the increasing of terminal rates was this idea and this concept of the lost generation. This generation of non-home buyer, let's say, 25 to 35, 25 to 40, that may not be able to get into homes unless interest rates are hiked so much as to bring housing prices back down to a point where it's affordable again. Apparently, the White House is very much focused on this lost generation theory and not wanting to lose this generation of home buyer, and basically make it so they don't feel any ownership towards their country, almost, I guess, is kind of the way to even look at this. So very revealing. They talked about immigration as well.
Okay, so hopefully you guys enjoyed that. So let's talk about that for a second, because this really is a important a way of understanding what the Biden administration, what the Fed may be thinking or talking behind closed doors. And so again, to reiterate what Joshua was saying here, this financial economic person, I forget where she works for, but she's one of the people that talks to Biden and his staff on a monthly cadence. All right, and what she's saying is that, okay, rates may be done for now, right? We may be done hiking, but what we need to be cautious about is the lag effects, the delayed effects, all right? Think back to what happened in 06. In 06, we hit rates same exactly where we are right now. It took another about 1.5 to 2 years before the whole 08 crisis happened. So we don't know what's brewing underneath everything that we haven't seen yet. And so one of the big fears from the Biden administration, the Fed, probably just in general, is what happens if we keep, if housing continues to rise at the rate it is, and it doesn't come down aggressively. Well, the problem is right now, to buy any house, I mean, especially where I live here, again, geographic bias, I get that. But every house, like crappy houses that you need to like tear down and build brand new, or that have never been updated, or houses that people bought back in like 2017, 2016, put in like 30, 50K into it. And they bought it back then for like 200, 300,000. They put 30, 50K into it. Now they're trying to sell it for $1 million, right? Or these houses need to be torn down. They're trying to sell them for $1 million, right? And think about that. $1 million, you put 20% down, your mortgage is gonna be about 7 to 8,000 a month. For something that essentially needs to be torn down or renovated, or something that somebody, just put some cheap LVT, some crappy LVT that's like ugly gray, and the aesthetic is just like a DIY aesthetic, and it's not $1 million property, right? I mean, it is today, right? The market dictates what things are worth based on who will buy it, right? Supply and demand. But the point is, this is a reason why the Fed may stay higher for longer, because people can't afford that. Right? Not everybody can afford a 7,000-8,000 a month mortgage for a house that needs to be renovated or torn down and rebuilt. Okay, so this could be a reason why the Fed keeps their foot on the pedal with interest rate hikes, right? Or at least keeping them higher for longer. And the reason for that is because there's something that happens in a culture, in a society, when people don't own property and own real estate, right? You lose that, connection to your city, to your country, right? It becomes something where you don't care about littering. You don't care about improving it. You don't care about that new restaurant that's going to open. You don't care about that new coffee shop, right? Because you don't have a stake in it. But when you own property, when you own land, when you own real estate, right, you become just more prideful for your city, for your county, for your country, for your state. And that is something that they don't want to lose. And right now, with the way housing is at, again, crappy houses that need to be torn down, rebuilt, are starting at $1 million, at least where I live. I'm curious. Let me know down below in the comments what it looks like from your area and your geo. Now, again, don't get me wrong. You can go, I don't know, an hour out into, the middle of nowhere and probably get something for 300,000. But again, 300,000, that's still a pretty decent mortgage, right? That's I don't know, that maybe it's a $3,000 mortgage, right? No, maybe it's less. Okay, so maybe it's like 2,000, 2,300 mortgage to be an hour out. Well, damn, why would I ever buy anything at that point? Especially if I'm a single person, I might as well live in a studio downtown so I can at least walk to work. And this is the problem, right? Housing, shelter, apartments, all that has just become increasingly unaffordable for the vast majority of people. I know a lot of people on the internet like to try and flex, like they're all making, $100,000+. But look, I live in the real world here. I look around, I know that that's not normal. I'm in tech. I work, out of Silicon Valley. So yes, there, right? 2, 3, 4, $600,000 salaries are the norm, but that's there. That's Silicon Valley, companies. That's tech companies. That's not everywhere else. That's not the norm. And so, even think about this. Even those people can't afford a mortgage of 7 or 8,000, right? That's still a very high mortgage. And that's, again, for something that needs to be torn down. So there is a disconnect here, and there needs to be a push going to come to shove, right? So either people need to stop buying these houses at such high prices and give the market or the housing market a chance to come down, and let the sellers, the sellers are the ones who are really going to take it on the chin, especially if they bought in the last couple of years, right? It's like a lot of these companies that took on new rounds of new funding rounds in 2020, 2021 that now can't go back to the financial markets. Why? Well, because the valuation for their company is way lower, so they would technically be underwater. So there's a problem here. And so this is why the Fed may stay higher for longer. And this is why you may want to be cautious about what you do, how you proceed. Now, the other reason I would be cautious, and this is my last point, is because right now we just got CPI. And sure, it was at 4.9. We got expectations, all that, great. But it does seem like inflation or CPI is coming down slower over time. It's coming down pretty much every month, but it seems like it's starting to stall out or slow down. And so this could become the sticky part of the economy or of inflation that the Fed really wants to, stomp out. And so we have another CPI reading that we'll get before the Fed has to make their next decision. Now, unless we see a decent uptick or things, aren't going the right direction, I believe that the Fed will pause at the very least for this next meeting. But it's something to keep an eye on. All right. So again, be careful of the lagging effects of these inflation rate hikes. Just because we pause doesn't mean that we have seen the effects of anything yet. Okay. These regional banks, that may just be a first sign of what's to come. We still have commercial real estate issues. We have home prices that are unaffordable. We still have a problem with people taking out $1,000 a month loans for buying brand new cars. So there's a lot of still problems structurally. And then don't forget, June 1st, I believe, is when the debt ceiling debacle needs to be resolved. All right. And everything will play into the Fed's decision. So be cautious, be optimistic. This is a good report. We should celebrate it, but we're not done. We're not out of the woodworks. And I think even once they're done hiking, we need to wait and see what happens. Okay. There will be better times to get into the market. There will be better times to buy real estate, but not financial advice. But what I'm doing, I'm holding off. I'm stockpiling my cash for you never know, right? Because we don't know what's going to happen. If we get into another '08 type crisis, then I want to make sure I'm as prepared as possible. All right. If you enjoy this type of content, do me a favor, hit the like button, hit the subscribe button, ring that bell. Love you all. Peace.